This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Hi everyone, welcome to this week's Simplifying Investing episode with me and me. Hey me.
Hi Deanna.
So we've seen a bit more volatility in the US share market, at least in the past week. The US S&P 500 is down by just 2.4% off its record high. So still around record high levels, but we have seen more reaction to some of the economic data that we've had, which is a bit of a change to recent weeks where we've sort of seen investors and markets look through the concern around tariffs and look through potentially some negative economic news. Although to be fair, the US data has been holding up until this point that we're at right now. What have you made of some of the recent prints that we've seen, including payrolls and the ISM?
Yeah, I think payroll was definitely the catalyst of that recent 2% drop in the S&P 500. So just a bit of context, payroll, which is the gains in the number of employed positions in the US, has actually been pretty strong. In May, it was increasing at a rate of 139,000 per month. In June, that was 147,000 just within the month of June. That's pretty decent, and that was actually running above the 12-month average of roughly 128,000 per month. At least that's what we thought last month. But last Friday, what happened was that the July data came out. July payrolls only increased by 73,000.
That's pretty low for a monthly print, right?
Yes, that's pretty low. But that's not the worst of it. The May and the June strong data were both revised down to just 14,000 and 19,000. So basically, it was revised down to just 10% of the original prints. That was a massive downward revisions just within the last 2 months. And people say that downward revisions could have made a difference in the last Fed meeting if we knew about the 14,000 gains in payrolls instead of 147,000. The Fed could have cut.
Wait, how can we just lose all these jobs in the space of 2 months? How can you find these? Have these workers just gone missing? What is going on in the Bureau of Labor Statistics?
Depends on who you ask. If you ask Donald Trump, he would say that it's because the data is rigged, and it's because the head of the Bureau of Labor Statistics, who is now fired by Trump, just deleted those numbers. But I think
maybe they forgot to add a zero.
But to understand why these revisions happen, I think we should actually take a step back and understand how these data is actually collected. So there are about 8 million businesses in the US, and obviously it's impossible to go out to 8 million of them every single month to actually get the data of how many people they employ. So what the Bureau of Labor Statistics does is that they just send out a survey to a subset of those 8 million, about 120,000 businesses or government agencies around the country. They make sure that the samples are representative of the whole economy, and they use that survey data to extrapolate to a full payroll employment number for the whole country. And we, economists and statisticians, we do trust these data because the surveys are very well calibrated. And also because of the law of large numbers, you don't actually need to survey every single person to know the rough average, how the economy is doing, as long as you do the samples right. The issue with that is that sometimes businesses, when they get the survey, they just don't fill it out right away.
Yeah.
So they will send our survey in May. They don't actually complete it until now because they're just lazy. Or maybe they just don't have people doing it. So the BLS, when they get those new information, they just incorporate those new information into the data. And that leads to revisions. Another thing with these revisions, I understand that how come all of these revisions have been on the downside lately? If it's just a random, error or random missing the deadline from businesses, then the error should be equally either upside or downside versus the original. Lately, it have been on the downside. This is actually quite common at inflection points of the economy. And we've seen this during the GFC or during COVID as well. When the economy is slightly weaker, then there are more exits in terms of businesses. So when the BLS sends out a survey, they don't get a reply. What do? They just have to have an assumption of what that business is doing.
Yeah. But maybe that business has gone, right?
Yeah, maybe the business has gone bankrupt in the meantime, whereas the historical modeling or assumption uses old assumptions that maybe they're still around. And that is exactly the reason why over the past 2 years actually, on average, every single month, the payroll numbers have been revised down by 52,000 every single month. That's actually quite significant.
And if you look through time, revisions to payrolls data in the US is actually pretty normal.
Yeah, so
it's not just in the latest few months.
Yeah. The latest few months have been on the downside, but the magnitude is nowhere near as big as back in the GFC or in the 2010s, for example. So, yeah, I still trust the data. I think we should be aware that all of these month-to-month numbers can have these volatility to them. But on a trend, they are still saying that payroll employment in the US is getting a bit weaker lately, and that probably is pointing to higher unemployment rate in the US in the near future.
Well, and the June unemployment rate was 4.3%, and that's up from, it bottomed at about 3.5%. So it has been a trend up higher, and I guess that the revisions to the payrolls just bring the level of employment closer to some of the other indicators that we have for employment, like ADP, Challenger, and closer to the data that the unemployment rate was showing us, because the payrolls and the unemployment rate come from two different data sources. So I think it all lines up with showing that we are seeing a bit of a slowing in the US economy, but not a collapse.
So you do trust the data?
I mean, I do trust the data because I think we have enough information from other sources like the PMI surveys, the ISMs, ADP, Challenger. As economists, we have to put everything together. And I think it just fits into the picture that the other indicators are telling us. I mean, sometimes I have trouble believing our own Australian labour force figures. We call it a labour force lottery for a reason. The numbers bounce around quite a lot. And we seem to find people or lose people all the time in Australia too in the employment figures. And it does come down to the benchmarking that the Australian Bureau of Statistics has to do around population estimates. And inevitably, payroll surveys are hard to do just because of the size of the population. But I think we should trust the data, even though we have been looking at the decline in the response rates for US payrolls. You did a great chart around the decline in the response rate for the non-farm payrolls figures. We used to have about 60% of people responding to that data. That's fallen to about 40% of people. So lower response rates, I guess, could mean that the quality of our data that we're getting is not as high as where it once was. But again, I think that just goes, again, to the point that we need to collate all the information that we have around employment to try and weave a story around it, or to really try and make sense of it. And of course, it's not right that Trump just fires the head of Labor Statistics because he doesn't like the data.
Yeah, and it is actually quite worrying because the Bureau of Labor Statistics has actually lost quite a bit of fundings. So a research by the American Association of Statisticians has found that on an inflation-adjusted basis, funding for most government statistical agencies in the US has dropped by 16% since 2009. And thus, in spite of the fact that we actually now have better technology to collect these data and analyze these data. So it is quite worrying for the direction of how all of these are going.
So it's not just the Trumpification of the BLS, the collection agencies, there, also the Trumpification of the US Fed, which we have spoken about in the last few weeks, about Trump putting incredible pressure on Powell in particular, but also the Fed to cut rates because he wants to lower the interest cost for the US, lower debt costs for the US government. And now one of the governors left this week a bit earlier than expected, so it leaves a spot for one of Trump's people. The betting markets are saying it could be Kevin Warsh or Kevin Hassett coming in. I mean, I would assume that they are quite dovish, but I still think that Powell has enough sway to get the consensus to an outcome that he would sort of like.
And I do agree, and I think we should keep in mind that Powell was a Trump appointee as well.
He was, yeah.
Back in 2016. Even though Trump kind of forgot about that. He actually forgot that he appointed Powell. So speaking of Powell, Trump has nicknamed him Too-Late Powell. And there is a big elephant in the room why he's deemed too late, and the Fed are hesitant to cut rates at the moment. And that's definitely the tariff situation.
Mm-hmm. Well, it sort of seems like we are getting to the end point around where tariffs are going to settle in the US, what the US is going to charge to all its importers. And we've been getting a few announcements around trade deals in the past week. The trade truce with China is apparently going to be extended because it officially is meant to end on August the 12th. And some of the trade deals that we had last week or in the last 2 weeks included the European deal, India. What did you make of some of the announcements that came out?
So in my assessment, there are some good and some bad things with this new set of tariff rates. Maybe let's start with the bad things first. So that would be countries that haven't made a deal with the US. There've only been a handful of deals, by the way, so not that many.
The ones that matter to the US, the ones that have the largest impact based on import ratios.
Yeah, so they're all mostly done. But a lot of the other smaller countries, I think, are going to see much higher tariff rates than we previously expected. And even compared to the Liberation Day tariffs, Switzerland is a good example of that. They export a lot of pharmaceutical products, as well as cheese, chocolate, and watches to the US. They're seeing a 39% tariff rates. So if any countries that hasn't made a deal, I don't think that's a really good sign for them at the moment. And we do see that average tariff rates settling closer to 20% now.
But that's still lower than, the post-Liberation Day highs, which was like averaging 35%. But I think that was mainly because of the impact of China, because they had the step-by-step changes to Chinese tariffs, right?
Yeah, that is true. But I guess to me, I think 20% is still prohibitively high. It's still going to push inflation up. Say 6 months ago, and we talk about a 20% tariff rates. That was actually unthinkable back then.
But better than 35, I guess.
Yeah.
That's how markets are seeing it.
Yeah. So I guess that's the minor bad part to this new set of tariffs. I think there's still a lot of good signs coming out of it though. One big thing is that some countries are facing lower tariff rates versus the August 1st letters. For example, South Korea and the European Union, they're both seeing 15% tariff rates, not 25 or 30 as he previously threatened. So that's actually a pretty good sign. And the best news for Australia is that we're going to see a 10% tariff rate on our goods as well. So that's actually the lowest compared to every single other countries. And that was...
That's on average though, but then we still have the steel and aluminium tariffs, which are still 50% based on the increase that he made. And then he hasn't announced anything on pharmaceuticals, which are one of our top three export to the US, and he's threatened up to 250% tariffs on pharmaceutical products, which could start in a year's time. So there could be some pressure down the track. But yes, I agree that Australia is getting the best of what is a bad deal.
So you're swinging me back to like the bad news side again. Anyway, it's hard to say that all of these tariffs are good news. I guess it's just better than what we feared 2-3 months ago. So, I mean, in the near term, in the near future, the outlook for all of these impacts of the tariffs will still be on the negative side. And
to the economy.
To the US economy in particular. So that would mean lower trades, higher inflation, fewer Fed cuts, and probably lower employment gains, as we've started to see with companies saying that they're very uncertain about hiring in the future.
Although in the latest US reporting season for the June quarter, I did see that there were fewer companies that spoke or that mentioned the word tariff as many times. I mean, I guess how many times can you mention it all? It wasn't as much of a factor in companies' outlooks than it was 3 months ago. So we just have to see how companies adjust to these high rates of tariffs, but they'll adjust by hiking up prices for consumers, or we'll see a decline in imports from global peers, and the US will be producing more of these goods, or maybe consumers will just have to live with fewer imported goods. Like Trump said, instead of having 15 Barbie dolls, you're going to have one Barbie doll. Back to the times of pre-globalization.
So let's move back a bit more local. We've actually had a bit more good news in Australia, I think. Our inflation outlook, on the contrary, is actually looking pretty better. And we've actually had the latest monthly inflation reading of just 1.9% below the RBA target band. And even the sticky trimmed mean number, the number that the RBA cares the most about, it was coming in at 2.67. So marginally higher than the RBA expectation of 2.6%.
That's for the June quarter.
That's for the June quarter. There are a lot of inflation measures in Australia,
Yeah.
and sometimes they're all saying different things. But I think from the second quarter inflation reports, we can all agree that the inflation numbers are looking pretty good. They seem to be sustainably moving back into the midpoint of the RBA target band. And markets are now pricing in a full rate cut from the RBA for the August meeting. So that's pretty good news.
I think it's fair pricing. I mean, to be honest, I thought it was fair pricing for the July meeting as well. And of course, the RBA didn't cut then. But I think that they've received the data that they wanted. They got the June quarter data. The Deputy Governor Hauser said it was a welcome inflation print, which I think basically keeps the door very firmly open for a rate cut at the August meeting. If I don't know what else they would need, or what other evidence they sort of need to cut rates. So I think that market pricing is quite fair. But the question to me now is really how cautiously will they proceed from here? And we think that the cash rate will end at 2.85%. But I have to say, maybe that's a little bit too dovish. Maybe the cash rate's actually going to end a little bit higher than that, and we're only going to see maybe 2 or 3 more rate cuts in this path for the RBA. From here, we had the retail data out for Australia for June. That was the last retail release. You were very sad about that, me. We've had the monthly household spending indicator, and they actually looked pretty good. It looked like retail spending was ticking up a bit for consumers.
Actually, it's been quite confusing. So if you rely on the retail spending data, then retail spending volume in the second quarter increased 0.3% in Australia. But if you look at the new experimental, actually it's no longer experimental, the new monthly household spending indicator, it actually increased 0.7% over the quarter.
But it's a broader measure than just retail. It includes every spending item.
But not everything. It includes more, but still not everything that's included in the GDP data. And the new indicator is actually very volatile. It moves around a lot from month to month.
But I think even despite all that, I think it's fair to say the household's looking better than where it was 6-12 months ago. And I'd hope so, because we've had a few rate cuts, we've had lower inflation, and we've had tax cuts. So if that wasn't enough to push the consumer to spend more, I don't know what else you sort of need. So from that point of view, it is good news. But again, I think it might keep the RBA quite cautious in cutting rates.
Yeah, I agree. I mean, part of the reason why we saw a spike towards the end of the quarter was 2 things. One is that Queenslanders started purchasing a bit more after the fake cyclone Alfred of the previous quarter. And there were a lot of promotional activity as well. So that has helped a bit. But I do agree that the consumer outlook is definitely going to pick up from here. And that's evidenced by leading indicators like household sentiment. It has been looking up quite a bit in Australia. So hopefully we'll see a bit more relief for the consumers, not just from real wages growth, but also from more rate cuts from the RBA. I think if we want a clue on how many more cuts we're going to expect to see from the RBA, we know that they're going to cut just how many more. We can probably look at their forecast. And so far, most of the economic indicators have been tracking pretty close to their forecast, with the market cash rate assumption of 3 more rate cuts. So maybe that would be, I know that's a bit fewer than what we're expecting, that we're hoping for in our forecast. But that seems to be market pricing as well, 3 more cuts.
Well, we'll wait and see what the RBA has to say at its August meeting when it releases its new forecast that it updates once every quarter. Great to chat, me. See you next time.
See ya, and fingers crossed for a rate cut.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.